Welcome, everyone. I'm Reed Alexander, a reporter on the finance team, and we're really delighted to have you for our first session in this event to tackle an important conversation around the global outlook for sustainable finance. You know, financial firms today are coming to the conclusion that doing the right thing when it comes to ESG, particularly sustainability, isn't just the right thing to do ethically or altruistically, but it has a meaningful impact on their bottom line. And from a fiscal perspective, it's a smart play. A growing body of evidence is supporting that conclusion if you just look at the data. For instance, new data that takes a look back at progress from the first quarter of this year from the data provider Refinitiv found that there were 220 plus sustainable M&A deals that took place in the quarter. That's a significant upswing from what we had seen year over year, and that amounts to more than 58 billion in consolidation activity. And then if you talk about sustainable bond issuance on the debt side, we saw more than $286 billion in issuance in the quarter. That's an all-time high. So over the next 20 minutes, we want to really unpack what the wins at the back of sustainability mean for the global financial services industry, both in terms of capital market advisory and on the buy side among investors. So we brought together a really phenomenal group of 3 experts in this space. We've got a lot of ground to cover over the next 25 minutes, so I want to go right ahead and point our first question to you, Melissa James of Morgan Stanley. So help us understand how ESG, particularly with an eye toward the E, environmental issues, sustainability, is really evolving in the capital markets, and what kind of implications does that have for capital markets decision making, Melissa?
2020 was an inflection point for ESG. And as a result, it's really now a mainstream topic. And one way in which that's manifesting itself in the global capital markets is with the explosion of issuance in the ESG labeled bond market. So you mentioned the $286 billion of issuance in the quarter. Last year, there was over $500 billion of issuance in aggregate in the ESG labeled bond market. And that was up over 80% year over year, 2019 to 2020. The growth in the issuance was really fueled by the fact that companies now recognize that investors are willing to reward them for incorporating sustainability features into their debt issuances in the form of a lower interest rate. That's why we've seen so much issuance activity. You couple that with the fact that we've also seen diversification in the type of issuance on a variety of fronts. So, for example, in addition to there being issuance that is specifically for environmental purposes, there is also now more social issuance where the use of proceeds is for social concerns, as well as sustainable issuance where the use of proceeds is for both social and environmental good. And so that's another way in which the market has evolved. A second form of diversification that we've witnessed is the advent of the sustainability linked bond, where now you're seeing not just use of proceeds issuance, where the use of proceeds is targeted to specific environmental and social projects, but you're also seeing issuance activity where the interest rate is linked to certain key performance indicators that are either social or environmental. So this really opens the path for a much broader array of companies to issue ESG labeled debt in this format, because there are a lot more companies that can establish these targets and reach these goals over time than there are companies that can necessarily define a specific use of proceeds today for these activities. So there's just been tremendous growth and tremendous diversification.
Yeah, really interesting, the intersection of E and S there. You mentioned social issues as well tied to these sustainable bonds. Really fascinating stuff sort of around the tools and the toolkit that are available. And speaking of which, there has been an advent of demand for all of this, and some firms are even responding to it by setting up designated units of their own. So I want to bring in Sandip Sen from Citigroup now. Citigroup has done something really interesting, Sandip, as you well know, in the past few weeks. Citigroup has set up an NRCET, Natural Resources and Clean Energy Transition Group, within its investment banking division, the BCMA division. Now, you co-head that division. So why don't you tell us what the impetus was to set that group up and some of the services that the group is tackling?
Yeah, thanks, Reed, and thanks for having me on this panel today. So yes, this group was formed about a month ago, a little bit over a month. It represents a reorganization combining the energy group, the power group, and the chemicals group, but it's called Natural Resources and Clean Energy Transition. And the impetus of forming that group was a recognition of the fact that all 3 of those industries, amongst other industries, are experiencing a rate of change that is frankly unprecedented. And each of those industries are interconnected in some way or the other. Thought behind setting up this group is to formalize and put discipline around the coverage and the nurturing of what we believe will be a new subsector of clean energy transition companies. What it entails is the emergence of new companies, existing companies being restructured, and this can come about via IPO, via spinoff, via asset sales, all of the above. What it entails is the emergence of new companies, existing companies being restructured, and this can come about via IPO, via spinoff, via asset sales, all of the above. And we want to be at the forefront of helping our clients, old and new, and we want to do it with the kind of focus that we generally provide to bigger companies. And the goal is really to expand the pie for ourselves in a selfish way, but more so and equally important, helping existing clients and new ones that get born out of this absolutely global super mega trend that is energy transition. So we're super excited, and we see a lot of opportunity for us and for our clients.
Exciting indeed. I mean, I think if there was ever a case study in the importance of responding to these issues, the fact that you've set up a designated team, and I personally am so fascinated as a reporter who covers banks in this idea of collaboration that perhaps we can touch on at some point in our discussion between bankers, since pretty much I think every client these days has at least an eye towards sustainability in some way, shape, or form. But I want to now switch sides to the buy side. I want to have a look at what investors are thinking. I want to bring in Meg Starr. She's with us from the Carlyle Group, the Washington, D.C. based private equity firm, where, Meg, you are the head of impact investing. And what I find so interesting about your particular role, I think when we think about impact investing or sustainability investing in a lot of companies, it's off to the side, it's complementary. There may be special initiatives, but they're not really baked into the entire comprehensive global investing strategy. Now, as I understand it, and I'm hoping you can paint a picture for us, you're working hand in hand with sector heads to make sure that impact strategies, ESG strategies, are folded into all of their calculus around deal making. So why don't you explain to us your role in collaboration with sector heads and how and why Carlyle sees this sustainability focused investing imperative as so core to the acquisitions and investments that you're making there?
We've taken a little bit of a different approach in this space because I think sometimes impact has this concept of an artificial binary between good companies and bad companies, and that isn't the reality that we live in. And so we very much view impact as change over time, and actually think that private investing is particularly well suited to that because we have the tools of longer time horizons, the ability to invest capital, a really significant focus on business transformation. And so at Carlyle, we think of impact as building better businesses because frankly, in this day and age, they're worth more. So a couple of quick examples building off of what Melissa was talking about. We've seen a lot of really interesting movement in the financing markets. We just bought a company earlier this year called Flender. It's a carve out from Siemens in Germany. Flender is an expert in mechanical drive technology, core manufacturing company, but they have a very significant and growing business in wind gearbox turbines. And so one of the things we did was we did €1 billion of financing when we acquired that company, and the cost of that debt was linked to the number of wind gearboxes that Flender can produce. And so if they're able to exceed targets, they get 10 basis points off their debt, and vice versa if they miss those targets. And so again, back to this idea of using the tools of private equity to think of impact as change over time. How do we help manufacturing companies diversify and really build business models for the new energy ecosystem? We've also applied that financing to our lines of credit. We just did a $4.1 billion line of credit for our America's corporate private equity, and the cost of that debt is linked to our Carlyle corporate commitment to having at least 30% diverse directors on our majority-owned boards within 2 years of ownership. We have clear financial evidence that leads to better outcomes. Our companies that have at least 2 diverse board directors have about 12% faster annualized earnings growth than our companies without diverse directors. And this was another example of a unique spin in finance of saying, how do we link those targets to better financial outcomes so we can further this convergence of environmental and social progress alongside of financial profitability?
Meg, thank you. I just want to bring back in Melissa on this point because we're talking about this question of bonds and sustainability and some of these targets that make issuing debt potentially more affordable if you do the right thing and you can prove that you've done the right thing. Can you help me, Melissa, to understand how exactly that works? Sort of describe those levers for us. And also, to me, it makes me think that companies must be really doing a deep dive now on how they can gather data to prove that they're meeting their targets that they set out at the beginning of the debt raising process. Could you just walk me through that, Melissa, how that works?
Certainly. So, in the case of transactions that are sustainability linked, where the coupon or the interest rate is linked to the performance of a particular key performance indicator, companies will specify up front what those indicators are. They can be either environmental or social or both. In the case of a sustainability linked issuance, they are both. So you'd have a target, as an example, of reducing your carbon emissions by a certain amount by a certain date. And you might then also marry that with a provision whereby you specify a certain percentage of diverse board members or senior management members that you're likely to have by a certain date. And effectively, you have to monitor yourself relative to those goals. And if you have not met those goals at that date in question, then there is typically a coupon ratchet that occurs as a result of that. In the investment grade corporate bond market, that coupon ratchet is typically about 25 basis points. In other markets, in the high yield market, as an example, there's been more variability in what that coupon ratchet actually is. But typically, that is the mechanism or the manner in which these transactions are structured. And effectively, it's really allowing companies to get rewarded for doing the right thing, as you said. So what investors will do is they will actually lend that money initially day one at a lower rate of interest than they might otherwise. So there is a greenium or sustainability premium typically associated with those issuances, where borrowers are able to save, again, in the investment grade context, anywhere from 5 basis points to as much as 15 basis points, depending on the situation.
Fascinating. Thank you for helping me understand that and our viewers. And before I come back to you, Sandip, and I will in just a moment, Meg, you touched on some of your corporate imperatives that Carlyle has announced, and you've focused a lot around diversity. I know we're primarily talking about sustainability, but a point that I want to make over the course of this discussion is how organizations can model good behavior. And we're going to talk about that on the banking side, but I do think it's really interesting on the private equity, investment, alternative asset manager side, how Carlyle Group has taken some stands around this, including most recently tying CEO compensation to diversity, equity, and inclusion focused leadership at the firm. Could you just give me an overview of some of these ESG related efforts, even if they focus more on the S or the G that Carlyle has put into place that you've been speaking about before?
One thing we realized is that we have this evidence that diverse teams make better decisions and lead to better financial outcomes. We need to think about that not just in our investment portfolio, but also amongst our own staff, because a lot of times in private equity, we're putting our investment deal team members onto portfolio company boards. We have mandated diverse slates in terms of hiring decisions. We have rolled out a training on unconscious bias across our different Carlyle teams, and that's resulted in real progress. About half of our AUM is led or co-led by women, which is pretty special in this industry. And so I think when we think about ESG, there are a lot of different categories that fall under this broad bucket. We like to think of them distinctly because the concept of being good at ESG writ large, what does that mean? There are very specific dimensions of business excellence where there are clear financial correlations. So we think of things like climate resilience, engaged employees, and importantly, diverse and inclusive teams. And so we've worked really hard to figure out where there are levers to drive social and environmental outcomes, but those outcomes that converge with performance.
Thank you so much, Meg. So now I want to bring in Sandip Sen from Citigroup, because speaking about modeling the right kind of behavior on this, banks have realized that it's not just about providing advisory services to their clients, but there's a role that the banking community can play in actually helping to, lead by example here. And clients see that and they follow it. So Citigroup, on Jane Fraser's first day as chief executive at the beginning of March, came out with a pretty bold announcement, which Morgan Stanley has done something similar as well, committing to going net zero by the year 2050. I was hoping you could explain to me what net zero emissions by 2050 actually looks like from a material sort of workflow perspective for Citi, what the goal is about, and also how you think that taking a stand like that can impact the way that your clients are thinking about this too when they see you guys coming out and making such a serious commitment.
Sure. So as you noted, our CEO made this commitment on her first day on the job, and it's a bold commitment. It will take a lot of work. Our measurement of net zero by 2050, because we're a bank, entails what we do with our clients, i.e. our portfolio, what that looks like. By the way, it's actually somewhat convenient because many of our clients have also done the same. So the direction of travel is, I would say, quite uncontroversial. It's not at all. Most of the clients we deal with are headed in that direction. And conveniently, we are here to help them. And by them moving in that direction, they will be helping us. And so we're helping clients think through how they allocate capital, how they are valued based on how they allocate that capital. Obviously, Melissa and Megan have mentioned how their debt costs can go down if they are, quote, doing the right thing, and the market is actually measuring them by giving them price concessions and or penalties if they didn't. So we're seeing that across the board. So when we say net zero by 2050, we're setting goals for ourselves, but derivatively also setting goals in some ways for our clients, but not just setting them and warning them, but simultaneously communicating that we are here to help.
Fascinating. Thank you. This data question is such a huge question that comes up in any conversation around ESG, but I have to hope that it's getting better and that we're able to move in the right direction on this. Melissa James of Morgan Stanley, at a high level, can you help me to understand what is the issue around quantifying some of these ESG targets in data form? I would think a lot of smart people are working on this, but how does that also play into some of these nuances around valuations, or I guess how does that trickle down into the boardroom? Because it's one thing to recognize we have a problem, but I'm keen to know how it shows up in the kinds of client interactions you have, the kinds of deals that you're doing.
Well, what I would say as it relates to data, Reed, is that the market is evolving, as you point out. And so as a consequence, I think we're not at a place where we have really agreed upon standardization with respect to disclosure around environmental and social issues. So that's one of the challenges, but that is coming. It's just a matter of time. What we're seeing from a valuation and an M&A perspective, I would say, is that ESG is being taken into consideration as it relates to the impact on M&A transactions. And we think that's the case because increasingly companies recognize that ESG can have an impact on valuation long term. So, for example, we've looked at the S&P 500 companies and the correlation between ESG stewardship and financial performance. And one place where we've seen a really strong correlation is between ESG stewardship and betas. So companies that, generally speaking, have better ESG scores tend to have lower betas. That translates into a lower cost of equity. When you have a lower cost of equity and a lower cost of debt, as we said, as a result of being a good ESG steward, that means your weighted average cost of capital is lower, and that is going to influence your capital allocation decisions. And it will, affect your hurdle rate as it relates to evaluating acquisition opportunities. So as a general matter, we're seeing companies take into consideration the ESG impact of their M&A transactions, just like they would take into consideration the impact of a transaction on other more traditional financial metrics like EPS or cash flow or credit ratings even.
Over the last year or so, the market, just as Melissa's saying, has started to differentiate, and what we have observed is companies with high ESG scores and those that are considered, good stewards of ESG tend to trade at a higher multiple. We've actually seen that, very, very precisely in the sector that I work on, and a higher PE multiple gives you a lot more flexibility to do other things if you wanted to use that currency.
Meg Starr from Carlyle, when you're assessing a strategic acquisition, what are some qualities around sustainability that come to mind when you're eyeing a company that may not be an ESG-focused company, but has made clear in the process of diligence or management meetings that it is thinking about these issues? What are some things that you're looking for and that you want to hear from a counterparty?
Well, and to this question of data, Read, I think ESG data is a source of huge consternation in the field, but I also think it's a huge opportunity because that's where active management can come in and differentiate itself. How do you actually use that data to drive differentiated insights in the investment process? So I'll give a couple of examples because ESG really used to just be a focus in the diligence phase. How do we identify material, predominantly downside risks, so we understand how to price them, integrate them into how we're valuing investments? That has expanded out significantly, obviously into value creation during the hold period, significantly into exit implications, but also backing up to how we're sourcing deals in the industries that we cover. So during diligence, we now use data for all sorts of things. For example, we were looking at a portfolio of assets on coastal real estate last year. And so we worked with a specialized climate risk consultant to help us model out data like sea level rise and extreme weather related events and how that could impact insurability. For certain assets, we do carbon pricing sensitivities during diligence because we want to understand as our companies increasingly exit into carbon constrained environments, how that could impact terminal value. During value creation, we're really focused on the material issues for a company. Not all ESG issues are created equal. Where can we really have that rocket ship growth? By taking advantage of changing consumer preferences for sustainable goods or new growth markets because of the energy transition. And then on exit, it's really honing in on what matters to that business and its future earnings potential. We just exited a business called Liberty Tire Recycling, and the ESG team at Carlyle worked hand in hand with them to help model out their impact thesis and quantify the environmental impacts of their core recycling business. That was an important part of the sale process, and they exited to an environmentally oriented equity sponsor. So we're really seeing data being used in very specific, nuanced ways. And I think because there is that lack of standardization, that presents a real opportunity for differentiation in how active managers are able to effectively integrate it into their process, as opposed to using it as a checkbox or compliance exercise mainly for marketing.
Yeah, no, that's really interesting. You said rocket ship growth there, which makes me think of the entire growth in the whole space of ESG. Just when we looked at that data at the outset, reflected the amount of M&A transactions, the amount of sustainable bond issuance. I think it's fair to say when we look back on Q2, Q3, Q4 activity from this year, we're really entering an inflection point where ESG seems to me to becoming part of the mainstream deal calculus. And I want to thank all of you. Our conversation could certainly persist, but I feel like I've learned a lot, and I hope our viewers have as well. I'll hand it back to my colleague, Amanda Cantrell, in New York.
Thank you, Reed, and thank you so much to Megan, Melissa, and Sandip for sharing these insights. Thank you all for joining. Goodbye.